Hi all and welcome to Money Manager's A User's Guide. I'm Nathan Peters. Today I thought I'd shine a light on a little understood or followed equity factor that is often maligned in the marketplace. Yes, I'm talking about short selling, and in particular the phenomena in which those stocks that are more heavily shorted tend to perform worse than those that are not heavily shorted. A phenomenon which we'll call crowding. For newer viewers out there, a quick review of short selling is necessary here. So shorting is an institutional market practice in which a manager borrows stock from a prime broker, paying that broker a borrow fee, selling it on the open market in the hopes of repaying her broker later with shares that she buys back at a lower price in the future, thereby pocketing the difference between the prices net of the borrowing cost and some benefit from the short rebate or cash or other securities that's held as collateral against the borrowed shares. There is quite a bit of asymmetric risk involved in shorting stocks, insofar as a single stock can trade at any price to the upside for various reasons, but can only ever fall 100%. That's the first barrier to entry when shorting, unlimited potential losses that compound negatively as the price goes up. Secondly, markets tend to go up, generally creating a natural headwind for the strategy. Third, as meme stock mania of early 2021 has shown us, the weaponized use of derivatives can create a technically driven upwards price spiral, which is self-fulfilling and extremely dangerous. And fourth, but not least, the strategy is short itself, in that when there is a stress in the market, like in March 2020, in the COVID crisis, people are bringing down risk, selling their longs and buying back their shorts in order to reduce the footprint in the marketplace. This activity also squeezes popular shorts disproportionately, precisely when you'd think shorts would help in a falling market overall. Okay, given all that, why do short sellers do what they do if the deck is so stacked against them? Well, I've had the privilege of meeting and knowing several of the best in the business, and it's anecdotally true that they are a little extra, little different than others by disposition. They value truth much more than keeping up with the Joneses. They have a sharp eye for accounting gimmickry, and they excel in holding promotional management to account, keeping track of what was promised and when. We don't need to rehash all the frauds this group of market participants have unearthed, but it is true that when they are not able to operate, the ultimate losses for regular investors can get quite large. See Exhibit A, Bernie Madoff, and Exhibit B, the recent Luna Terra crypto implosion, each of which lost investors about $60 billion. At least with Madoff, a large portion of assets were recovered and clawed back. There's a great recent podcast in which George Noble, an experienced investor, was able to confront a representative of the largest remaining stablecoin out there, Tether, which I think illustrates the animus of the short seller class. They have deputized themselves where they believe the regulators are lacking oversight, and they are channeling Gomer Pyle with citizens' arrest. I'll leave a link in the description below to that podcast. So we have established that short sellers seek out asymmetric risk to the downside. For them, sounds like they better be right to take on that kind of risk. And the data shows that over time, this crowding factor makes money for this very reason. In academic parlance, shorts appear to be informationally advantaged. Over 14 plus years of history, this market neutral factor has earned a 1.2 Sharpe ratio on low volatility. Not bad. In fact, only the quality factor has done better. And it's decorrelated to everything. So who says you don't want to be short in rising markets? And over the last year, crowding is the best performing factor on a risk-adjusted basis, returning almost 11% with a volatility of 3% for a fantastic 3.3 times Sharpe ratio. So why the sudden surge? Well, risk assets and interest rates have been down in a more or less orderly fashion as liquidity conditions have been intentionally impaired by the Fed in order to fight inflation. It is Warren Buffett's infamous tide going out, exposing who's swimming naked. The shorts figured this out before others and are being rewarded. And the cycle plays out again and folks can't get enough short exposure. Maybe investors will start to recognize the enduring value shorting offers for a portfolio and let the pros engage in their odd little craft, undisturbed in the background, making the world a little truthier and risk-adjusted returns a little better. Well, that's all from me today on Money Managers, a user's guide. If you found this content interesting, please like, share, comment, subscribe, and hit the bell for notifications of future episodes. And remember, use your money managers. Don't let them use you. Thanks.